Hi class, want to go over with you chapter 3. By now hopefully you have read through the chapter at least once. So now let's try and break the chapter down, help you to understand it fully in case you're unclear on some things. One of the first things you'll notice in the chapter is that it talks about double entry. Double entry means every transaction has a dual effect, meaning every transaction you do, there's a debit to it and there's a credit to it. And this is how we get into our T accounts. Every account that you have has a T account, meaning one side, which is the left side, will always have a debit, and the other side will be the right side, which is a credit. We'll get into the decreasing and the increasing here shortly, but make sure you understand that T account. So you'll have a T account for your cash account, for accounts receivable, accounts payable, owner's equity. All of those accounts have their own individual T account with a debit and credit side to it. As you also notice, if we come over here, let's think about our accounting equation that we learned about during the first week. Assets equals liabilities plus owner's equity. It also has a T account. So the overall T account to the accounting equation, one side, which is our assets, has debit and credit. Our liabilities have a debit and credit. And our owner's equity has a debit and credit side. So our large T account, under that large T account, we have individual T accounts, which is what this is. You'll have those individual T accounts. Now, when we're looking at an asset account, if we debit it, it means we're going to increase that asset account. And if we credit, we're going to decrease that asset account. When we go over to the liabilities, if we do a debit to a liability, we decrease it. And if we do a credit to the liability, we increase it. Same holds true for owner's equity. A debit will decrease it, a credit will increase it. However, there is a catch in the owner's equity. If you look down here, there's two accounts that do the opposite under owner's equity. And that's the owner's drawing account. Whenever we debit something on the owner's drawing account, we increase it. And whenever we credit it, we'll decrease it. And then under expenses, whenever we debit something, we'll increase the expenses. And if we credit it, we'll decrease it. So keep that in mind. Those two accounts are the only two accounts that go differently under the owner's equity. Some types of accounts that you may find under your assets would be cash, accounts receivable, furniture, building, vehicles. When you think about assets, assets is something you own that has a value to it. So when you take that and use it for your personal life, consider maybe you own a vehicle. If you own a car, it is an asset to you. Now, if you have a loan on that car, that loan is the liability to you. Okay? So liability means things that we owe, we have to eventually pay back. Accounts payable, notes payable. As well, our owner's equity, we have capital, revenue, drawing, and expenses. Okay? Another thing you want to make sure you pay attention to when you are analyzing transactions is sometimes the transaction will say something was purchased on account. When you see those words, on account, that means it's either an accounts receivable or it's an accounts payable. So if you purchase something on account, it's in a sense saying that you purchased something using a loan. So now that you're going to have to pay that back, that's an accounts payable. It's a liability. Okay? So make sure you pay attention to that when you're doing your transactions. We're going to go through a few transactions in the chapter, but make sure you're paying attention and you analyze each and every transaction so that you fully understand what it's stating. All right. So let's move into our actual textbook. Oh, one other thing I want to point out, a few things. And hopefully when you're reading through your textbook, you're taking notes. That's going to be valuable to you because you may need to refer back to some notes or refer back to a chapter to make sure you understand something. One thing that we talk about in accounting is normal balances. And that just means what side of the account gets the increase. So for our assets, our normal balances are going to be a debit. For liabilities, our normal balance is going to be a credit. For owner's equity, our normal balance is going to be a credit because that's the side that gets the increase. Except for, remember these two accounts, drawing and expenses, it's the opposite way. So expenses, our normal account is going to be a debit, and drawing, our normal account, is going to be a debit. And normal account just means that after you've done all your transactions, whatever the difference of your transactions, it's going to be, you either put it on the debit side or the credit side, depending on which side it gets that actual, does the increasing. Make sure when you are analyzing transactions that you are going through the steps that are listed on page 55. Page 55, they list 3 different steps in making sure you understand the transactions. It's going to be important. Try not to rush through the transactions and try not to wait until the last minute to do them. Sit down, think through each transaction. Also, before you move on from one transaction, make sure that your debits equal your credits for the transaction you just finished. So if you have a transaction for $500, you should have a debit for $500 on one of the accounts, and then you should have a credit for $500 on another account. Alright, so let's go to your actual textbook. And we're going to go on to page 55. I want to kind of go through some of these transactions with you and help you to understand the transactions. I won't go through all of them, so you'll need to finish up by going through each of them, making sure you understand it. But I want to go through a few of them, and then we'll jump ahead and kind of understand the whole trial balance a little more. So on page 55, the first transaction, it's an investment by the owner. And it says that Damon Williams opened a bank account for a deposit of $2,000 for his business. So let's think about what's going on there. Damon, put yourself in Damon's position. You have opened your bank account for $2,000. So you've taken $2,000 of your own money and you've put it into the bank account. So we have a debit for cash of $2,000 because we're going to increase our cash. We opened a bank account. We didn't have anything in it. Now we have $2,000 in it. And we're also going to have a credit of $2,000 to our capital. This is how much we've invested in our business so far, that $2,000. So you notice I have a credit and I have a debit, and they both equal one another. Okay, let's look at the next transaction. Purchase an asset for cash. So Damon bought a motor scooter, which is delivery equipment, for $1,200 cash. So step back and think about what's going on here. He's bought something, equipment. It has a value to it, similar to your car. He just decided to buy a motor scooter, and it's for $1,200. So how did he pay for that? It says cash. We're going to credit, because we want to decrease our bank account by $1,200. We pulled $1,200 out, so we must credit that bank account. And then we have to recognize, what did we do with that? We bought some equipment. Equipment is an asset to you. So we increase our equipment account. We didn't have one at first. Now we have an equipment account, and we're going to increase it to $1,200. I have a debit for $1,200 and a credit for $1,200. I'm in balance still. All right, let's look at the next transaction. Purchase of an asset on account. Remember I said pay attention to that wording. So Damon bought a second motor scooter on account for $900. So now let's think about it. On account. He didn't use his cash. He bought it on account. More than likely got some type of loan for it, or he may have just agreed to a 30-day note or something. But we don't touch our cash because we didn't take anything out of cash. However, we did buy something on account. We have to eventually pay this back. That's accounts payable. And we have to increase it by $900 because now we have this note that we have to pay back. Accounts payable means something we have to pay back. Delivery equipment, we get to increase that by $900 because now we have a second motor scooter. So that's another asset to us, $900. So when I look at that, I have a debit for $900, a credit for $900. I'm still in balance. Okay, let's go through transaction D. Payment on account. Damon made the first $300 payment of the scooter he purchased in the previous transaction. So remember, we owed $900, but now we've made our first payment. So we get to decrease our accounts payable by $300. But how did we pay that? We paid it through our cash account. So we took money out of the bank and went and paid on that loan. So we have a debit for $300, a credit for $300. Okay? Now let's go ahead to this next transaction. Kind of skips on 2 pages. So you're going to have to see the first part of it is on page 57 at the bottom. And this is delivery revenues earned in cash. So this is where we've earned some money from whatever our business is and they've paid us in cash. Damon made deliveries and received $500 cash from his clients. So we need to go to our other page to see how that transaction holds up. Sorry, I clicked the wrong page. Okay, so on this one, this is one where, remember, Damon made deliveries and received $500 cash from his clients. So we have $500 cash in hand. We're going to go put it in the bank. We're going to increase our bank account by $500. That's our debt. That's our debit. And then we have to recognize, what was that $500 for? It was for revenues. In his business, he calls it delivery fees. It may be service fee. It may be consulting fee. Whatever your business is, how you recognize what your revenue is called, it's still revenue. And we must increase our revenue because we've earned $500. So we have a debit of $500, which we increased into our bank account. And we have a credit for $500 because we've now earned $500 for the year. Okay? So go through the rest of the transactions doing those same things. Looking at what the transaction says and paying attention to what the transaction is doing in each of the T accounts and where it falls on the particular part of the accounting equation. So once you get done with all the transactions, and these transactions go through page, I believe, page 65. So go through and make sure you're understanding those different accounts. But then we're going to go ahead and go to the trial balance. And what a trial balance is, it is a list of all the transactions we've done. So we take all of those transactions from all those previous days, and we're going to then come and bring them all under each particular T account. Notice that we have the revenue. Here's all of our T accounts. This is every transaction. If you've gone through all of the examples in the book, this is every transaction. And you notice at the end we totaled up what was our debits in the cash count, what was our credits in the cash counts. The difference between the two, remember on this one, an asset has a normal debit balance because that's the side that normally increases. Same thing when we look over here on the liabilities. We add up our liabilities on the debit side, and then the credit side, we take the difference. 2,100 minus that 300 gives us a balance of 1,800. We put it on the credit side. The balance goes on the credit side for this because that's the side that increases it. Okay? Same thing is going on for each of these other accounts. So now that we've had all of those accounts, we've summarized them all, now we're going to bring it over to our trial balance. Okay? So if we go back to this page, page 66, we see under the cash account, the balance should be $370. So we go to our trial balance, cash account should be $370. And it should be $370 on the debit side. Remember, debit side is the left, credit side is on the right. Same thing for our next account. We look at it, We say accounts receivable should have a balance of $650. Let me go to my trial balance, put in accounts receivable, $650 on the debit side. And you do that for each one of these accounts, every single one of these accounts, supplies, prepaid, insurance, delivery fees, owner's draw. Each one of those accounts, you will then come and list it here, and you'll put, it's either a debit balance and what the balance is after all transactions, and then you'll put your credit balance for any of those accounts that have credit balances. Remember, the normal balance is whatever side gets the increase. Assets, that will be a debit. Any of your assets should all be a debit balance. Liabilities, owner's equity, is all going to be a credit. Keep in mind, except for those two odd accounts. Which odd accounts are those? Expenses and owner's draw. Those are the only ones that they don't fall like the normal owner's equity does. Okay? When we get done with all of that, we total up everything in this debit column, everything in this credit column, and they both should equal one another. If you got that, then you're doing well. And for this week's assignment, you don't have financial statements that you have to prepare. However, I want you to take a look at the financial statements. On page 68, it brings back over your trial balance, which is what you're going to do for your homework. You're going to do a trial balance. But then it also shows you how to take those numbers and plug them into the various financial statements. You have 3 financial statements: income statement, statement of owner's equity, balance sheet. Here's some tips on these different financial statements. You have to complete the income statement before you can complete the statement of owner's equity. You must complete the statement of owner's equity before you can complete the balance sheet. The income statement will only have revenue and expenses. That's it. Those are the only types of accounts you should ever put on an income statement: revenue and expenses. And if you take a kind of look, most of the expense accounts have the word expense at the end of those. The owner's equity will only have whatever your retained earnings is, or your net income. It's going to have whatever the owner invested in the business and whatever the owner took out of the business. So you're going to have what the owner invested in the business, what the owner took out of the business, and also the figure that you got at the bottom of your income statement. You put those on there. Then when you move to your balance sheet, the balance sheet is only going to have assets, liabilities, and then the owner's equity amount. Okay? So when I look at the assets, these should be accounts that have a value to them. You should not have revenue listed here. You should not have any expenses listed here. Only assets should be listed. Under liabilities should only be things that you have to pay back. Accounts payable, notes payable if you have to pay a note back. And then under owner's equity, the only thing that should be listed is whatever figure you calculated here on the owner's capital. Once again, these should equal. The balance sheet has our accounting equation on it. Assets equal liabilities plus owner's equity. This is where our accounting equation tells us, are we really in balance? Did we really do what we were supposed to do? All right? So go ahead and get started on your Chapter 3 homework. I will be uploading a worksheet on Chapter 3 with a few hints on it. You want to make sure you use that worksheet because it's going to help you out on knowing, am I doing what I was supposed to do right? Have I gotten my figures to where they should be?